So I recently had what could have been a losing credit spread that I turned into a profit of $1,569. And today I'm going to share with you exactly what I did. I'm going to take you through the trade as I placed it initially, how it went against me, and ultimately what I did to overcome it and turn a profit of over $1,500. So, first things first, not financial advice or investment advice. This is just what I did. Don't copy random strangers on the internet. That's not a smart thing to do. Do your own research, make your own decisions, get really good at managing your own money. With that said, let's jump right on into the charts and exactly what I did. So, the trade I placed was on Credo. Now, I entered on this day here, May the 11th. Now, a lot of people will go, it's not a red day. I know. Remember, I don't enter sold puts, credit spreads, etc. on red days. I enter them based on technicals. So, why did I choose to enter on this day here? Because we had broken through this level of previous resistance. We'd done so with a convincing green candle, convincing volume. I wasn't quite convinced though that this wasn't a fake out because of the RSI. So I wanted to be in a trade in case it wasn't a fake out, but I also wanted some protection to the downside. So rather than just selling a put, I chose to enter as a put credit spread. So I went with strikes of 165 and 155. Why I did that is going to become really apparent in a moment, but just know that this is the entry day and this is where my strikes were. Now, I received a total of $129 in credit for that trade. Let me quickly show you. These are my transactions. So remember, I'm in Australia. I live in the future. May 12 is actually May 11 trading day. So these are the contracts I bought and sold. On May 11, I sold the May 29 165 put and I received $316. I subsequently bought the May 29 155 and that cost me 187. So had I have just gone with a sold put at 165, I would have been up by $316 for this trade. Okay? Remember that. That's key. Let's come back to the chart. So remember, I need by the 29th, which is the end of this week, to be above 165 and that trade wins. I think we're going to be there, right? But we had this huge drop down in the meantime. And this is what I thought potentially could happen and why I went with a spread. So remember the put that I bought. Now, a bought put gains value as the stock price comes down. So when we got to May 18 and we had reached as low as this 50 EMA, my bought put was really quite valuable. Let's come and check the trades that I placed on May the 18th. Again, they're down here. May 19 is actually my day. May 18 is the trading day. Let me show you step by step exactly how that played out. So on the 18th, Credo dropped. My $155 contract that I had bought not long beforehand, only a week beforehand for 187, that's now worth 12.35. So I sold that. Okay, remember I'd bought it, so it's mine to sell. So my total that I'm into this trade for now is the 316 that I received when I sold the 165 minus the 187 when I bought the 155, so 129, plus the 12.35 that I received when I sold it. So I'm up a total of 13.64. And I could have just let that be. So let's come back to the chart and see exactly what that would have left me with. It would have left me with this, a sold put at $165. Now, to do this, you do need the ability to hold that sold put in your account. So you need available cash or margin to buy 100 shares at $165 if that circumstance arises. Okay. So I actually thought, you know what? Just in case we do continue to come down further, I'm just going to roll this down a bit. So I rolled that down to 155. So my new sold strike is down here. Let's check what I actually did. So I rolled my May 29 165 out to June 18 to a 155, which means I bought back my 165. So that cost me 18.95. But then I sold the June 18 155 and I received 2100. So all up, the rolling of that sold put, I was up by $205. Add that to the 1364 that I've already received from this trade, and in total, I'm at 1569. Now, granted, I could have just left all of this to expire on the 29th without doing this part, or I could have rolled and kept the 165. But I thought, you know what? Let's just play this safer yet again. So, remember when I said 316 was an important number? Because ultimately I've landed on just a sold put anyway, right? So I've still got the same capital in the trade now as I would have if I just went for a straight sold put. But because I anticipated that this might come back a bit, I was able to turn that from 316 to 1364 ultimately, because this here would have happened potentially either way. So if I only had the sold put and I still chose to roll it on this date, then I'd be up by 205 and 316. So 520 odd dollars. I got an extra $1,000 out of this trade because I chose to take it as a put credit spread instead. So ultimately, come June 18, if we're above 155, this trade plays out exactly how it is right now. Yes, we've got earnings coming up, so anything's possible. But Credo, one of the main reasons I do like to play Credo is quite easy to roll and still get a credit. As you saw, I was able to roll my strike by $10 out a couple of weeks and still get a $200 credit. So if I have to continue to do that, potentially, if we look like, you know what, maybe we're going to fill this gap created here, then that's 135 and I would be happy to do so. I've already made $1,500, so I'm already at, well, 10%, right? I'm already at a 10% return. So the way I like to look at things also is worst case scenario, if this trade takes a year to play out, 10% return is still better than my 5% in the bank, right? Not that I anticipate this is going to take a year to play out, but that's another kind of way that I like to, talk myself through, okay, what's actually happening in this trade? But otherwise, I'll have a 10% return in a little over a month. So you can take a look at the numbers here again if you wanted to just kind of see that process. But I thought I would share that with you guys just as another way that you can manage trades that you're doing. And even if, you would normally place a put credit spread and you're like, you know what, I'd usually do a put credit spread and I don't have the available funds to, um, you know, break it apart and ultimately turn it into a sold put. That's okay. So be it. But this is more so for if you would usually sell the sold put and you're like, oh, I'm not sure the downside risk has gone yet. This is a way that you can kind of balance that a little bit. So anyway, I hope you found this helpful. Make sure you like it if you did. Make sure you subscribe if you're not already subscribed. And I will see you next time with another video.